This is Asia Trade. I'm Shery in Tokyo.
I'm Avril in Singapore. The top stories this hour. Asian stocks set to extend Wall Street declines as traders look beyond this week's likely Fed rate cut. Treasuries joining a global bond slump as anxiety grows about the pace of future easing. A win for Nvidia as President Trump approves the sales of their H200 AI chips to China, with the U.S. to take 25% cut of revenue. And Paramount launches a hostile cash takeover bid for Warner Brothers days after the studio agreed to a deal with Netflix.
We'll be watching Japanese assets today after that big earthquake struck Japan's northeast coast. We're seeing Nikkei futures under pressure. The Japanese yen headed towards 156 against the U.S. dollar. We have seen significant pressure for the Korean won as well. We're hearing from local media that authorities are establishing an FX stabilization task force, so we'll continue to watch the Korean currency as well. The offshore yuan, a different picture. We have seen actually strength against the U.S. dollar, holding at that 7 level per greenback. And this, of course, after the Politburo announced that top priority for 2026 will be boosting domestic demand, although Goldman Sachs calling that somewhat disappointing. The big news today, of course, will come from the RBA as well. Not much expected. No change in the policy rate is the expectation by economists, but 10-year yields already at the highest level since 2023. Avril, we're seeing that expectation of a hawkish shift coming from Australia.
Yeah, and that is, I think, part of the concern when it comes to the Fed, the extent in which it will be a hawkish cut later this week. And ahead of that, we are seeing the U.S. stocks starting the week down, snapping a 4-session rally. Maybe some of the upward pressure in yields is sapping demand for stocks. We are seeing the U.S. 10-year hovering just above the 416 handle now. And if you look at swaps, they are pricing a bit lower the extent in which we will see cuts in 2026. Now, maybe also the upward pressure that we're seeing in yields is supporting the greenback. But one of the stocks that we're watching, Shery, is that of Nvidia. This is a company that closed in the green. We heard from the U.S. president saying he spoke to Xi, and in part of that conversation suggested that the U.S. would approve the H200 exports to China. But the question still lingering over the extent in which China will demand or want these chips, Shery.
Yeah, let's stay with Nvidia and bring in our Asia tech correspondent, Annabelle Drewlers, for more details. Belle, just as Avril alluded to, of course, a big question is the demand outlook in China, even if these chips are sent over there, right? But how significant is this for Nvidia itself?
It's significant for Nvidia itself, and I think, yeah, you're pointing to maybe not even the million-dollar question. It's probably the multi-billion-dollar question: is what kind of demand are we going to see on that H200 side? We don't know that yet, but what we do know is that the H200 is a much more advanced chip than the H20 that was initially modified for the mainland market. So the H200 is one that has already been sold around the world, but of course we're moving to Blackwell, we're moving to Rubin architecture, so China still will be a couple of iterations behind. But yes, this is a big announcement that's just come through in the last couple of hours, but President Trump giving Nvidia permission to ship these H200 chips to China. It's something we've been discussing for weeks. We saw Jensen Huang just back in Washington even last week continuing his lobbying efforts. So on this front, it certainly is a win for the business. As you said, we've got this True Social post here. You can see President Trump saying that he had warned or informed President Xi of this, Xi responding positively. This is something, of course, a lot of Chinese companies are going to want to see as well. They're still sort of hamstrung by these access to more advanced chips. The question, as you said, is whether China will allow them to purchase. But at the same time, in terms of the breakdown of the deal, so the Commerce Department says it's still finalising the details on this sort of accord, but we do know that 25% of each sale is also going to be going toward the US as well. So it's an exchange here for a 25% surcharge. So it's this a potential maybe to billions of dollars in the mainland market. But of course, you think about the latest earnings, and China was completely ridden out of the picture as well.
Bell, on top of this, maybe we're seeing another win for the AI community, with Trump also signaling he wants to do away with state-based rules.
Exactly. Yes, this is something else that Jensen Huang has spent a lot of his time lobbying on. And one of the big concern has been as these states in the US move to protect consumers in their home grounds, it was actually creating a lot of confusion for big tech companies who were facing regulations, lots of different regulations, or at least that is the comment that big tech has been making. So what President Trump has just again announced on Truth Social in the last few hours is that he wants to approve an executive order this week establishing one rule for AI instead. So he wants to do away with state-level policies regulating the technology, and instead he wants one federalized rule in place instead. So we have seen a draft of a potential order at Bloomberg. We saw that in the last few weeks, but it would this draft rule, it showed us that it would allow the DOJ to sue states over AI regulations it deems unconstitutional, or as well threaten funding cuts to those states with laws that are considered too burdensome or restrictive. But regulation, of course, has been a very hot topic for quite a period now. President Trump has been more on the less regulation side instead to try and promote the development of the industry, and it does seem that this is another continuation of those efforts as well.
Belle, thank you so much for getting us up to speed. Annabelle Drawlers there. Now on to one of our other top stories. Paramount has launched a hostile cash takeover bid for Warner Brothers Discovery just days after the Hollywood studio agreed to a deal with Netflix. Following his warning that the Netflix deal may pose an antitrust problem, President Trump says he'll also be looking at the Paramount bid.
I have to see what percentage of market they have. We have to see the Netflix percentage of market, Paramount, the percentage of market.
Let's bring in Chris Palmieri, who leads our media and entertainment coverage in Los Angeles. So, Chris, this is quite a turn of events. Following on from the prior bid from Netflix, now Paramount with its hostile takeover bid. What do we know about how successful all this might be?
Very unclear, as unclear as the president was there, I think. This is still to be decided. But I mean, the $30 that Paramount came out with publicly today was what was rejected by the Warner Brothers board last week. There's a debate over whether their bid is higher than Netflix, because Netflix involves spinning off some cable networks that have some value to Warner Brothers shareholders. So there's 10 days at which Warner Brothers has to respond. They've told shareholders, not to do anything at this point.
Chris, the world is following this deal. Why is it so consequential for the media industry and just streaming in general globally, and the implications of what this might lead to?
Well, Netflix, the largest, the pioneer in streaming, the largest player globally, over 300 million subscribers, having them control some of these outstanding, well-known entertainment brands, Batman, Harry Potter, Game of Thrones, all of that comes with this deal would be huge. And so that's what they're fighting for. Paramount, of course, obviously has a long history. It would be a merger with another 100-year-old Hollywood studio, huge catalog, a library of TV and movie titles, and would strengthen them by combining HBO Max, their streaming service, with the Paramount Plus streaming service. So, also with global reach.
Also begs the question what this is going to mean for consumers, maybe higher prices and less choices in terms of media options. But Chris, there's been talk about Sarandos reaching out personally to Trump. And then when it comes to Paramount, there's been talk that touting up of that personal relationship with the Trump administration as well. Does this in any way tell us the odds of either side getting a deal?
I wish. I mean, certainly conventional wisdom was that the Ellisons have been big supporters of Trump. They control Paramount. But as you mentioned, we broke the news yesterday that Trump had a meeting in the White House over an hour with Netflix co-CEO Ted Sarandos, and Sarandos left the meeting thinking that Trump wouldn't oppose the deal. for them. We're also about to report, if we haven't already, that last night at the Kennedy Honors in Washington, David Ellison talked to Trump again and also hosted some dignitaries in his box there at the event. So there's a lot of lobbying going on in Washington. Not a lot of clarity, though, how it's all going to turn out.
Good to have you with us. Chris Palmieri, who leads our media and entertainment coverage in Los Angeles. Coming up on the Asia trade, we'll look ahead to today's RBA rate decision with TD Securities. IG joins us to talk market strategy. We also discuss Australia's ban on children having social media accounts. Much more ahead. This is Bloomberg.
Anxiety about the pace of Fed easing next year dragged U.S. stocks lower ahead of this week's meeting, where a cut has been priced in. Traders in Asia will be awaiting the RBA's outlook after today's likely hold, as well as assessing China's Politburo meeting with its focus on boosting domestic demand. Let's get more with Bloomberg M-Life strategist Mark Cranfield and our chief North Asia correspondent Stephen Engel. Mark, let's start with you first. So it looks like in U.S. assets, they are pricing this hawkish cut. You see stocks down, the dollar's bouncing a little, treasury yields coming under pressure. What is this going to mean for Asia?
Well, the key thing really is the very long end of the Treasury curve, where that goes and what impact it has really across the world. And we're beginning to see it play out because now the Treasury market is also responding to what we see from the RBA in Canada, in Europe, and even from Japan, of course. So this upward pressure on the very long end of the yield curve is a bit scary for equity markets globally. If you think back to the middle of the year, the first time the 30-year yield in America hit 5%, there was a wobble across global equity markets. They recovered, of course. But our colleague Mark Cudmore is suggesting that this time we're getting close to the 5% yield again. This time we're going to go through it, we're going to go above it. And for next year, the 5% will be more of a floor than a ceiling for 30-year yields. That's a pretty scary scenario for equity markets. And part of the reason for that is that investors are not sure that the Fed is looking at both sides of its mandate. It has an inflation and a jobs mandate. It's much more concerned about the soft jobs data. That's why they're lowering interest rates. But if you look at where the 30-year is, since they lowered rates in September and October, yields are higher at the long end of the curve. That clearly says that investors are worried that core inflation is not coming down to compensate for the high yields in the market.
Asian markets will also be reacting to what's happening in China. Steve, we got the priorities out of the Politburo meeting, but the expectation right now that perhaps some measures are a little bit muted at the moment.
Yeah, I think the senior leadership in Beijing feels fairly confident that they weathered the storm coming from Liberation Day from the United States back in April through to today. Yes, the economy has lost a little bit of a momentum, but it's been powered by that surge in exports, those numbers that we got. So it's leaning on that traditional pillar. And it wasn't a disaster, the Chinese economy this year, despite the tariff barrage coming from the United States. So there's this policy tone that the Politburo behind closed doors in Beijing set, and we got the readout yesterday, essentially is mostly a continuation of the current policy settings. No big surprise. They're going to be focusing on internal demand, domestic demand, but they didn't really specifically mention consumption, household consumption, as it relates as well to policy and, property policy going forward. And it really sort of hints that there's going to be a continuation of policy. They did mention proactive fiscal policies, moderate monetary policy. There's no change there, but no real big bang stimulus going forward. So that's the key readout from what I can see. Jacqueline Wrong, the chief China economist at BNP Paribas, says is going to be stimulate demand but stabilize supply. And they also are going to be strengthening new productive forces. Again, the new industries that are going to be the drivers of the future. But that also indicates as well that there won't be any rollback of industrial production, manufacturing. So it won't necessarily be setting the tone to cut back on that overcapacity issue in many industries. Now, this Politburo meeting sets the tone for policy next year. Now it will be up to the next meeting of the Central Economic Work Conference to really put the details and the policy that will then again essentially be ratified in March at the National People's Congress.
Yeah, I think, Steve, that markets are waiting out for the next catalyst when it comes to China assets in general. Talk to us about what you're hearing in terms of reactions. Some have called this Politburo readout somewhat disappointing.
Well, those were the words from Goldman analysts. Somewhat disappointing is the readout because, again, it's essentially a continuation of this current year's policy. And a lot of market participants have been looking for greater stimulative measures from the Chinese policymakers, but they've been resistant. As I said earlier, I think they're fairly confident that they've weathered the bulk of the storm. And they're going to go ahead with their longer-term planning, with the next 5-year plan and the cross-secular policies, which indicates more of a longer-term perspective. But that Goldman readout from Li Shengwang, the economist at Goldman, China economist, essentially saying top leadership appears sanguine on China's economic growth this year and during the 14th five-year plan, and highlighted continued policy focus on technology, security, and people's livelihoods. They appear less inclined towards broad-based stimulus measures. And again, the Goldman economists essentially highlighting what I did earlier, and that is they didn't have specific comments about consumption and about the property market. Maybe that's going to be fleshed out by the Central Economic Work Conference in the terms of policy, but in the readout, it was fairly consistent with this year's policy priorities.
And yet the concerns are real, right? The economic challenges that China faces. You alluded to the property sector. We have China Vanguard's ongoing problems. We do have soft PMIs. Mark, when it comes to other economies and markets, how consequential could what China's going through be, especially for heavily dependent economies like Australia, for example, where we do have an RBA rate decision today?
Yeah, everybody in Asia is very concerned in which direction China takes. And as far as Australia is concerned, we're beginning to see signs that investors think that the RBA could shift into a territory where they start lifting interest rates next year because there's been improvements in the Chinese economy. Australia is starting to benefit from that. And the inflation's a little bit sticky in Australia as well. Now, that's a tremendous change. It was only a few weeks ago that people still thought the RBA may be on for lowering interest rates again next year. But the messaging from today from them could well be it's a bit of a hawkish hold. They're not expected to change interest rates, but looking forward into 2026, they may well signal that they're starting to see enough signs of growth and inflation outlook that they may even need to move to higher rates. They may not make it clear today, but clearly the market is starting to think that is the case. And it's not just Australia. Just in the past couple of weeks, obviously we're seeing clarity. The Bank of Japan almost certain to raise interest rates. Very strong data in Canada, which is pointing to the next move being an upward move there. And just yesterday, the European Central Bank, some pretty hawkish comments from Schnabel there, suggesting that she's comfortable with the idea that markets are pricing for higher rates. So across the G10 space, we're seeing the balance really tilt in favor of slightly higher rates next year, even as the Fed is considering an interest rate cut this week.
On top of that, Mark, maybe a bit of a shift in the market dynamic in Japan, given how demand from foreign investors has been drawn in. That also brings with it volatility. Yeah,
I mean, just because yields have been rising quickly in Japan, we're getting close to this 2% threshold on the 10-year sector, which has been a target for a long time. People at one stage were thinking, OK, once we get to 2%, everything will calm down. But what's changed a lot in the past couple of years is more people involved in the Japanese market. We've seen a massive growth in derivative trading. According to the BIS data, the volume of derivatives traded in Japanese rates market has gone up something like 700% over the past couple of years. A lot more senior traders being employed in Tokyo. We're seeing more curve trading, basis trading. There's an awful lot going on in Japan, which suggests that people will continue to trade, do a lot more activity. Even if yields reach some kind of a ceiling, there'll be a lot of other things going on. So short-term volatility will likely stay high in Japan.
JGBs are back. Mark, thank you so much. Bloomberg M9 strategist Mark Cranfield and Chief North Asia correspondent Stephen Engel, thank you to you both. We have more ahead on the Asia trade. This is Bloomberg.
Here are the latest from the corporate front. PepsiCo has announced a series of operational changes backed by activist investor Elliott Management. The moves include cutting nearly 20% of its U.S. product lineup, investing in more affordable products, and planning layoffs in North America. Elliott says the plan will drive greater revenue and profit growth. Bloomberg has learned that Walt Disney is bringing Jimmy Kimmel back for at least one more year under a new deal with ABC. Sources tell us Jimmy Kimmel Live will continue until at least May 2027. We're told the host and Disney agreed on the extension months ago, but delayed announcing their plans out of respect for axed fellow late-night host Stephen Colbert. Morgan Stanley has lowered its rating on Tesla to the equivalent of a hold. Analysts say the company's full valuation, driven by its stock price, already reflects its robotics and AI businesses. The firm says Tesla is positioned to be a leader in humanoid robots, but EV sales volume in North America may fall 12% next year.
Shery, also watching AMD, its CEO Lisa Su is pushing back against market worries over AI exuberance. She tells Bloomberg Television that the technology has yet to reach its full potential.
I find it kind of interesting that you go from super excitement about a technology to, oh, wow, big concern. Look, being a engineer and technologist for a long time, you see technologies and you see those that are kind of fads, and then you see those that have extreme potential. And AI is in the realm of extreme potential. The last 2 years we've been talking about it. We've seen sort of the advent of ChatGPT now turn into, is there a AI bubble? And I say that we're just starting to see the real utility of AI. Yes, the investments are high, but why are we all so confident that there's a payoff at the end? Because we can see, the way AI has been improving over the last, let's call it couple of years, has been faster than any other technology that I've seen. The adoption rates have been faster than any other technology. The potential is faster than any other technology. But what I'm here to tell you is that it's nowhere near its peak capability.
AMD CEO Lisa Su speaking to Bloomberg. And we'll be watching Japanese assets in trading today. The Japanese yen moving towards that 156 level against the greenback. We're seeing downside pressure on Nikkei futures. We had a big earthquake off the coast of Japan's northeast. We are now hearing from Prime Minister Takaichi saying that there are reports of 30 injuries from the quake. There are some stocks that we'll also be watching. ANA, for example, saying that there's no impact on flights following the earthquake on Monday. But other stocks like Ineos Holdings, for example, which evacuated their facilities, will be on watch. We have more ahead on the Asia trade. This is Bloomberg.
Let's take a look at how global bonds are faring after Treasury yields rose to the highest in 2 months ahead of the FOMC decision. Of course, among bonds in G10s that have been underperforming, it also includes Australia. And we are watching out for the RBA decision that's due today. Consensus is for a hold. Question is the extent in which the RBA will sound hawkish due to these renewed inflation pressures. Let's discuss and bring in Prashant Prashant Newnaha, Senior Asia-Pacific Rate Strategist at TD Securities. Prashant, good to see you.
Yeah, good morning.
So we are watching out for what the RBA says in terms of messaging. You don't seem to think they'll be terribly hawkish. Why?
So I think this meeting is going to be very closely watched. I mean, we've had a significant sell-off in Aussie fixed income over the last 7 weeks or so. So I think 3-year bonds have sold off roughly around 75 basis points. So, I mean, the data has definitely come in stronger. And the markets, I think, are going to be looking for validation from the RBA whether that sell-off is justified or not. And I think that the RBA is going to fall short of that, essentially because the RBA is going to tell us that they think that inflation expectations are anchored. And if they're anchored, there's no need for them to actually come out and say, you know what, the next move is going to be a hike. I think what they are going to indicate is that, yes, price pressures are actually increasing. They've actually come in above our expectations. But we're trying to figure out whether these price pressures are temporary or whether they're more persistent and permanent. So I think they're going to require a couple more months of data to actually determine whether that's the case. And for that reason, we don't think that they're going to jump the gun and actually signal a hawkish bias. So I think there is going to be an acknowledgement that data has come out stronger, but they're still going to be playing a data dependency approach.
So what are we going to likely see? What might we likely see in the market reaction today, given what's already been priced in then, and what makes sense to you in positioning going forward?
So I think, you know, if you look at it very simply, 3-year bonds in Australia, you know, they lead the cash rate by roughly 6 months. So the 3-year bond yield at around 4% is already got a rate hike sort of priced in over the next 6 months. It's not exactly priced into the OIS market, but what we are expecting is that if the RBA doesn't validate the market's recent sell-off, then we're going to have a relief rally. So yeah, you probably get 3-year yields falling by around 5 basis points and the curve, you know, moderately steeper. But it's not going to be a material move. I think, you know, the data that we've had over the last couple of weeks has been very strong. And I think that the market's bias will really be to sell strength in fixed income. So that's why I don't think any rally is going to be significant.
Does that mean that we could also see an unwind when it comes to Aussie dollar calls? Because I've been watching the Aussie Kiwi very closely because of that divergence in monetary paths.
So, yeah, I think there's probably going to be some reversal, but I don't think that the outlook's really going to change too much on that Aussie Kiwi. I think, you know, the RBA is facing stronger data, and the risk is that, you know, data over the next couple of weeks is going to be strong as well. I mean, we ended up having some data on consumption come out last week. GDP data was all stronger, and I think that's the trend that the data will come out and play to. RBNZ, it's just too far to be able to call a change in policy. They're going to be at least on hold for the next year or so. Data is starting to turn up a bit more positive, but we still think that the position is to be long Aussie versus Kiwi.
And how about the Aussie against the greenback? Because, of course, we are also pricing in a potential Fed rate cut this week.
That's right. I think in terms of the Fed, the expectation is that they're going to deliver a hawkish cut. So that should provide some support for the US dollar. But broadly speaking, I think, you know, you have a look at the trajectories. The risk is in the US that the unemployment rate goes higher. In Australia, we think that the risk is that the unemployment rate goes lower. The data has been a lot firmer in Australia versus the US. So we actually think that having long Aussie dollar positions versus the US still makes sense. In terms of our forecast, we've got Aussie trading to around 68 cents by the middle of this year and towards 70 cents by the end of this year.
What are the risks to the view of more hawkish RBA in 2026? How closely are you watching perhaps the spectre of deflation being import from the likes of China? And then that might also affect the trajectory for the Australian Central Bank.
Well, that's it. I think the RBA has made it quite clear that the economic outlook is very uncertain. That's been a thematic that they've expressed in the last couple of meetings. So I think they're going to contain that. They'll still retain that view. In terms of deflation coming through, I'm not sure whether that plays through at the moment. If you have a look at the Chinese M1 money supply growth year on year, that has a very good lead on China PPI. And it does look like we could actually see China exporting inflation via PPI. So that's the risk over the next 6 months. So I think in terms of price pressures, the risks are that price pressures continue to increase as opposed to decrease.
Okay, interesting. Talk to us about yields as well, the long end concerns. This is a global issue, right? Especially in DMs. What is your sense on the Treasury yields? What is going to look like this time next year?
So our house view is that the Fed will probably deliver another 3 cuts after the cut that we've got this week. So it should take the Fed funds to around 3%. So our view is that US 10s get to 3.5. So we're quite aggressive on our call on US Treasuries, but we are expecting the Treasury market to rally. We've already had the Fed tell us that QT is likely to end, and we're expecting that announcement to come through. We've already had the Fed also tell us that they're considering reserve purchases as well, so that should be supportive. But as we think that the labour market's likely to weaken in the US, that should provide a tailwind for this US fixed income rally. So we think that US 10s by the end of next year should be around 3.5.
Any upside for Japanese government bonds? Of course, we have a whole different dynamic here with JGBs.
So I think what we are seeing across global fixed income is that yields at the back end are continuing to rise. We've seen it in the US, even though the Fed has delivered 2 cuts already and a third one's on likely. Yields at the long end of the curve are continuing to rise. I think there's just a shortage of savings out there globally, and that's helping to drive yields higher, particularly in Japan. So the risk is that, we get above that 2% level on JGB 10s. But it is a good news story. The data has been coming out more positive in Japan. You have a look at corporate profits, for example, they're up 14% quarter on quarter. We're expecting that to filter through into the Tankan survey. You look at consumption in Japan as well. The consumption activity index from the BOJ, that's at levels that we saw back in February of 2020. And consumer sentiment is at levels that we haven't seen since, I think April 2024. So overall, it is a good news story in Japan. It probably means that yields go higher, and the risk is that the rise in JGB yields probably filters through into other markets as well, such as Australia and the US.
Yeah, we do watch the Tankan survey next week, as well as a BOJ policy decision. Prashant Newnaha, good to have you with us, Senior APAC Rates Strategist at TD Securities. Now, the chief investment officer of one of the world's biggest bond funds is warning of dangerous assumptions in the credit market. Pimco CIO Dan Ivascyn says inflation ratings may be giving investors a false sense of security just as the Fed faces limits on its ability to step in. The warning comes as private credit expands rapidly, with funds competing aggressively to write loans once dominated by banks.
It is very, very dangerous to assume something has an investment grade rating just because the rating agencies assign a rating to it. It's critically important that you do your own credit work. Today, all too frequently, you'll have an investment grade rating from one entity. And again, market participants for years have always joked, if you can only find one investment grade rating, it's pretty fair to assume everyone else is below investment grade.
Pimco CIO Dan Ivascyn speaking on Bloomberg's Odd Lots podcast. Meantime, Bridgewater Associates founder Ray Dalio says investors are not paying enough attention to government debt levels. Speaking to us at Abu Dhabi Finance Week, Dalio told us more about what he sees as the biggest market risks in the coming year.
We are having too much debt. Now, this is not just the United States. You're seeing this in England, you're seeing this in France, you're seeing this in China, you're seeing that dynamic. So that they can't increase the debt the way they did before. And then related to that is the politics. But when you have these large wealth gap differences, who has the money? And when there's the accumulation of a lot of wealth that then isn't taxed, there's a tendency to want to tax that wealth. And that creates bubbles. In other words, when wealth is very different from money. In order to spend money, you have to sell wealth and get money. And when there's a lot of wealth that needs to be sold. So quite often interest rates play that role. But you could see wealth taxes play that same role, meaning the need to sell that. And that creates a bubble. So we have a debt bubble going on. We have that other kind of a bubble going on in the economy and related to politics. And then, of course, geopolitics. Capital flows and trade flows are different because we have a world in conflict. And in that world in conflict, no country could be secure. So that's why the United States wants to build self-sufficiency in these areas. Or China, which is that model where China would export to the United States and earn money and then invest in bonds, is no longer a viable path because the Chinese worry that they won't get paid on their bonds like the Russians don't get paid on the bonds. So that dynamic is what is behind now what's happening, and it's becoming more precarious as we go forward. Like if we go into the 2026 elections, it's likely that the Democrats will take the House. Significant possibility. If that happens, the political conflict will continue to be more difficult, and so on. And that's creating this risky environment. Particularly also, debts are maturing. So what you have to roll over your debt at a higher interest rates. This confluence of factors is making the environment more risky as we're going ahead.
And I want to talk a little bit about what sort of concern investors globally are underplaying. But before that, you talk a lot about AI, and I wouldn't be a financial journalist if I don't ask you a question specifically targeted AI, especially in Abu Dhabi right now. Bloomberg reported a couple of months ago that a venture that your family office had with G42 did not pan out. Are there any other partnerships in the city we should be on the lookout for?
I'm very active in doing AI partnerships and in areas of common thinking, AI and investing. In other words, I guess I would say we're in this environment where there's a networking of different people of different expertise. And I think as we're dealing with how to be the best investor, you have to have the ability through AI to do that. And the partnerships are thought partnerships of how everybody can, teach each other and do things together. So, yeah, there are a number of things that are interesting and going on, and I'll keep you posted as things develop.
Bridgewater Associates founder Ray Dalio speaking with Bloomberg's Abir Abu Omar. We have more ahead on the Asia trade. This is Bloomberg.
Let's take a look at how commodities are faring. Copper, top of mind after rising to an all-time high, and partly to do with China setting these domestic growth priorities for next year. It is interesting, though. We have been seeing precious metals doing pretty well so far this year, but a bit of a pullback overnight against the backdrop of what the Fed might do and how it might signal a bit of a pullback in terms of tamping down the market's expectations of those rate cuts next year. For more on the outlook for copper, let's bring in Bloomberg Asia Energy and Commodities editor Andrew Jane. So, Andrew, let's talk about copper first. I mean, on the demand side, things look great. Supply also supportive of prices. What are you seeing in terms of the drivers, and what is this going to look like in 2026?
Hi, Avril. We used to call copper Dr. Copper because it was a barometer of global economic health. That's certainly no longer the case. It's surged 30% this year, while the global economy sort of wallows in a tariff-induced funk. And a lot of that is on the demand side. People have been talking for several years now about how copper being such an important part of the energy transition, that the demand's really going to kick in, and I think that's what we're seeing this year. It's been fueled further by the AI data center boom, which requires a lot of wiring. Then on the supply side, we've had a series of mine outages. There is a shortage of copper. That's driven a lot of M&A activity as big miners try and get access to more copper. But I would say, yeah, the demand's not going away. New supply is going to take quite a long time to come on. So I do think we're in for a period of sort of prolonged high copper prices.
Andrew, what's happening with precious metals? Is it all the monetary easing path that's factoring into prices, or is there idiosyncratic news around supply and demand as well?
Well, in precious metals, in recent weeks, the monetary policy has been the main driver, but I mean, the reasons we've seen the big gains this year aren't primarily related to monetary policy. They're about the debasement trade. That is the fear that rising debt levels and governments will debase the value of investments in currencies and government bonds over time. We've also got the huge amount of uncertainty around trade and economics with all the tariffs. That's really fueled a flight to safety. In silver, which has been kind of the star for the last month or two, taking over from gold, we had a pretty dramatic short squeeze in London. That's the centre of sort of global precious metals trading. In October, they were flying silver in from other parts of the world. People couldn't get enough silver. That was partly driven by the fact that gold had gone up so much that some investors may have sort of rotated into silver. Silver's more than doubled in value this year. Gold's up around 60%. What happens with interest rate moves in the US, obviously important, but probably over the longer term hasn't been the main thing driving gold and silver. Fed independence will be really important for precious metals. If there's evidence that Trump and his administration are really eating into the Fed's independence next year, that could fuel a further sort of rally in precious metals as people become even more worried about investing in US government bonds.
Do we have a sense of what sort of levels we should be watching, both on copper and these precious metals? What are you hearing among traders, for example?
Well, in copper, CITIC Securities in China recently talked about a 450,000 tonne shortfall of refined copper next year. What that means for the price, I'm not quite sure. I think it means obviously prices are going to stay high. They also said copper at 12,000 a tonne, staying above that on a sustained basis would be what's needed to drive a lot of new investment in mines. Obviously, if that happens, it's still going to take several years for those mines to come on stream. So, yeah, I think we're looking at high copper prices for a while. Precious metals, there's been all sorts of predictions. Some people are saying gold could go to 5,000 next year, which is entirely possible. I bar some major sort of external shocks, I think gold and silver prices are going to stay pretty high.
Andrew James, good to have you with us, Bloomberg Asia Energy and Commodities Editor. We have more ahead on the Asia trade. This is Bloomberg. Australia will ban under 16-year-olds from accessing social media platforms from tomorrow, a decision aimed at reducing the harms of toxic content and cyberbullying. It's a move being closely watched around the world as the other governments considering following suit. Bloomberg's Paul Allen joins us now from Sydney. Paul, so how will this ban work and how much support does it have?
Well, Shery, it's got tremendous support. A YouGov poll just a couple of weeks ago found 77% support among Australians for this ban. There were a whole lot of catalysts that got us here as well, but one of them was the suicide in 2022 of a 15-year-old girl who had been relentlessly cyberbullied by classmates, and that led to a sense that, look, enough is enough. Something has to be done here. So this is the something. As of December 10, it will be illegal for an under 16-year-old to hold a social media account in Australia. So that includes the likes of TikTok, Instagram, Snapchat, even YouTube as well. Anthony Albanese, the Prime Minister, says other platforms will be added as necessary. Now, the onus, importantly, is on the social media companies to block accounts of under 16-year-olds, and if they fail to comply, well, there's fines of up to $32 million.
Given how the onus will be on these firms, how difficult is all this going to be to enforce, Paul?
Yeah, the enforcement question keeps coming up. And of course, any child under the age of 16 with even rudimentary knowledge of the internet is probably going to be able to find a way around this. And this frequently comes up. But the example always given is underage drinking laws. Also easy to get around. But it's more about throwing down a marker about what's socially acceptable and what isn't. And it's also the government saying to parents, look, we've got your back when it comes to parenting and setting boundaries for your kids. The social media companies, as you might expect, are not particularly happy about this. Meta and TikTok have agreed to follow the ban, but they also say there are better ways to do this. Snapchat, YouTube also just reject their classification that they are social media platforms, but they say they'll comply as well. But all platforms also point to measures that they've already undertaken to protect youth. But this law is coming in regardless of many weeks and months of representation of these companies to government as well. But to your point at the beginning, this is being really closely watched by other countries, and a variety of countries, Indonesia, Malaysia, Spain, Denmark, Brazil, they're all looking at this experiment to see how it goes, and we're likely to see similar moves in other regions around the world next year.
All eyes on Australia for the launch of sorts, the enforcement, how this rolls out tomorrow as well. Paul Allen in Sydney. We have more on the social media ban coming up on Australia Ahead at 11:40 a.m. if you're watching in Sydney, 8:40 a.m. in Hong Kong. Meantime, let's get you a check on what futures are showing us, and following on from that dismal performance on Wall Street with upward pressure on yields, might that similar dynamic also play out in the Asia session? It's worth noting when it comes to Japanese stocks, this weakness is coming despite the relative weakness you're seeing in the Japanese currency. It will be an interesting day for assets across the region as we keep an eye out for the FOMC later in the week. Markets open next in Seoul and Tokyo. This is Bloomberg.
This is Asia Trade. We're counting down to Asia's major market opens and still on watch for global central banks Avril ahead of the Fed's expected rate cut. And today, the RBA expected to hold.
Absolutely. The question is, down. Given how Australian bonds have been underperforming in the past week, you also have to consider how markets have already been positioning. So maybe we see that unwinding a little post-RBA decision, Shery.
Yeah, the 10-year JGB yield, Australian bond yield, in fact, at the highest level since 2023. But I talk about JGB yields because this has been a really global story, right? When it comes to long-end yields continuing to rise, we continue to watch the JGB market here in Japan because we do have a 5-year auction as well. We have been watching Japanese assets under pressure before the session. You can see the Nikkei still barely managing to rise 0.2%, and the yen holding at that 155 level, very close to that 156 level against the US dollar. We had a big earthquake on Japan's northeast coast. So what we'll be watching today is for announcements coming from companies about how that has affected their work. We heard from Prime Minister Takaichi that 30 injuries have been reported so far. When it comes to big, significant infrastructure fallouts, we haven't seen that as of yet. There have been some companies like Eneos, for example, that have evacuated some of their facilities. So do watch out for those names. Take a look at how South Korea is coming online. We, of course, had the news in the overnight session about about Nvidia potentially being allowed to export those H200 chips to China. So we are watching the tech sector for some potential upside. But you can see the Kospi at the open early down 0.7%. And even SK Hynix, which of course has tripled this year, down 0.5%. It just got its second investment caution warning from the Korea exchange, given the incredible rally that we've seen in this market. The Korean won holding at that 1468 level. We have also heard from local media that Korean authorities are now setting up this FX stabilization fund, given the volatility that we're seeing in the Korean currency, Avril.
Shery, what's also been rallying gold prices this year, you're seeing it just under the 41.95 handle. But of course, it's about where we go from here on the Fed and the rate trajectory. So looking at what treasuries are telling us, you're quite unchanged on the 2-year. The 10-year continues seeing the upward pressure. It's really the long end, given the inflation concerns, descend perhaps that the cut that is coming in a couple of days from now might be coming in too soon, given the trajectory of price pressures. On top of that, consider as well, might the upward pressure we're seeing in yields be finally providing some support for the dollar, because you did see it pick up a little bit. We are also tracking, as you said earlier, the 10-year yield in Australia as we keep an eye out for that decision and the signals coming from the RBA, Shery.
Yeah, let's discuss all of this. And joining us now is Fabien Yip, market analyst at IG International. Fabien, good to have you with us. And as Avril mentioned, of course, we continue to expect that Fed rate cut. And at the same time, potential pivot to a more hawkish RBA. Of course, we already have expectations of a rate hike in December here at the Bank of Japan. Is more monetary policy divergence going to be the theme in 2026?
Yes, this is what we're watching at right now, because central bank policies will be dominating market sentiments in the next 2 weeks. So today with the RBA, I think it's almost certain that the RBA will be keeping rates unchanged. The bigger question is what the trajectory would be next year, as we saw inflation numbers coming in pretty hot in the October CPI print. The headline inflation hit 3.8%, which is above what the peak the RBA has projected for next year. So if this trajectory continues, and if the projection of RBA is correct, where inflation will not see its peak until perhaps late in first quarter next year, then we're pretty much set for potential review of a potential rate hike in 2026. While this is not our base case, we're keeping a very close eye on those numbers, as well as RBA's tone today, because if they believe the recent hike in inflation rates is temporary and could be subdued in early next year, then there is not so much of a concern of a hike next year, which would be our base case.
Fabien, how does the AI narrative play into the markets in 2026? We do have Nvidia's headline, for example, today about those H200 chip exports to China.
Yeah, that's right. So it's a good news for Nvidia, for sure, that they got the approval to export these chips. The bigger question is whether China is going to take it, because we did see earlier this year where the Chinese government has been encouraging local tech companies to be adopting their local chips instead of Nvidia's chip. So if this narrative doesn't change, I guess it's quite hard for Nvidia to realize that profit. The good news, though, is in the recent earnings discussions from Nvidia, we did see that Jensen Huang said their projection on revenue growth as well as earnings growth has not been including the growth in China yet. So anything that could be shipped to China is actually an upside for the company.
To what extent are you expecting that to benefit the Asia suppliers?
I think the Asia suppliers will definitely play a very important role in the overall AI chain. Obviously, Japan, Korea, Taiwan have actually been dominating the upper stream of the AI supply chain. So the ongoing improvement in margins as well as the growth in AI demand will continue to drive a pretty prosperous outlook for these companies. The big question here perhaps is whether valuations of these respective companies are justified.
When you look at Chinese tech and the idea that maybe they don't need these H200s, given how their domestic options look to be making a lot of progress, how do you position, how do you advocate as an investor when it comes to Chinese tech?
I think the Chinese tech companies are at a slightly different stage, I would be saying. If you look at the AI chatbots that are happening in China, for instance, obviously we know that they're making a lot of progress, but at the same time, the monetization model looks quite different from the US tech companies. I think the Chinese companies are trying to gain market share as they are doing similar moves in other sectors, such as food delivery. The margins that are happening in the front end of the expansion cycle looks very different from what we're seeing in the US. But I think it's going to be a leaders take all type of market where we expect to see the leaders in tech continue to grow in their AI capabilities. CapEx spend obviously is another concern that we're watching very closely as margins have already been compressed. If CapEx increases significantly, it could put further pressure on the balance sheet of these Chinese tech companies.
Fabien, what about the Chinese economy itself? I mean, we saw from the Politburo readout that they want to prioritize boosting domestic demand, but Goldman Sachs calling this somewhat disappointing.
I think it's not surprising to see that they have a shift towards domestic demand. If you look at the trade data yesterday, it's actually a bittersweet moment, I would call it, because if you look at the exports, the growth is actually pretty strong. It recovered quite nicely right after the deal with US has been struck. However, import growth rate is still slow, reflecting low domestic demand. The other problem we're having here is it seems like the dependence on export growth is still pretty strong, and domestic demand, which is largely driven by consumer sentiments, and that has been impacted by China's property sector crisis, it's still pretty low. So a shift towards consumer sector, domestic consumer sentiments is a pretty clear direction that the Chinese government is adopting. How well can they execute that, like whether by continuing the consumer stimulus program, by handing out cash where people can replace their old home appliances, etc., can still continue to propel the momentum is a question that we have. I think it needs to be a more structural change in the entire economy, and we need to see an improvement in the property sector for the entire sentiment to improve.
Fabien Yip, good to have you with us, market analyst at IG International. These are some of the stocks that we're following in the South Korean session today. SK Hynix under pressure after receiving its second warning this year. Investment caution after the stock tripled, given the AI boom that we're seeing in 2025. LG Energy Solution also down, despite the fact that these two stocks could benefit from local media reports saying that authorities could be announcing as early as this week easing of regulations for holding companies. They could structurally benefit, but right now it's a down day for the Korean equity markets. We're also following some Japanese stocks that could move given what we experienced overnight. The yen has recovered after weakening with that powerful magnitude 7.5 earthquake that struck last night off Japan's northeast coast. Authorities have now lifted all tsunami warnings for Aomori, Hokkaido, and Iwate. Japanese Prime Minister Sanae Takaichi, though, says 30 people have been reported injured. We've had no reports so far of significant impact on infrastructure or nuclear power stations. We have more ahead on the Asia trade. This is Bloomberg. watching Asia chip-related names after President Trump granted Nvidia permission to ship its H200 AI semiconductors to China. That's in exchange for the U.S. getting a 25% cut of the sales. For more, let's bring in our Asia tech correspondent Annabelle Drewlers, and a pretty mixed picture when it comes to chip names across Asia. There seems to be some skepticism that this will actually make a difference.
Yeah, I think that's really the big question, a multi-billion-dollar question, in fact, because we know that Nvidia has completely taken China out of any sort of financial projections for the company. But now that Trump has given the green light for them to start sales of H200, that is the key unknown. Will Chinese companies want to actually buy them, or will they be allowed to buy them? Because what we've seen with the H20, for instance, and after the flip-flopping from the Trump administration on whether they could or couldn't, even with sales of H20 allowed to go ahead, still companies in China were being essentially told, please don't purchase these or don't purchase these. But H200 is sort of quite a different ballgame here, because it's the chip that was being sold also to other international customers, US customers as well. It was the first chip, for instance, to integrate HBM3E memory chips as well. So it has significantly more compute power, more bandwidth as well. So this is a much more advanced chip that Chinese companies, of course, would like to use if they are allowed to, in fact. But, I mean, it is something that's being questioned, of course, and we've just seen a response, for instance, from Democrats in the last half hour or so, and they're saying that this is significantly more advanced than anything that mainland China has access to right now. It's going to allow them to continue making advancements in AI and to erode the leadership that the US rather has in this space as well. So a lot of unknowns, including, as we going back to the key one, which is whether actually we do see Chinese companies buying these H200 chips. But as we said, President Trump has given approval for Nvidia to start shipping, and also to other companies like AMD and Intel. They're also eligible for similar chips as well.
And Belle, we're also hearing how President Trump is looking for regulatory clarity for AI players. One rule, he said on social media.
Yeah, one rule instead of having multiple dozens of different state-based rules. And this has been, again, I mean, it's another win, I guess you could say, for Nvidia. They've been wanting the companies that have really been pushing back against the way that this regulation was shaping up. Because the situation that we were seeing was that lots of different states were choosing to regulate AI in potentially different ways. And that was creating confusion for companies as well. Now President Trump has gone on social media, on Truth Social, saying that there is going to be only one rule book if the country will continue. Again, it's all about that AI leadership, but he is planning to issue a one rule executive order this week. So essentially, again, just making it, cutting the red tape essentially for big tech and making it easier for them to conduct their business. So again, it comes down to that competition you see between the US, China, other countries as well.
Belle, thank you so much for running us through the nuances on all these AI developments. Annabelle Drewlers, our tech correspondent. Meantime, China's senior leadership has set boosting domestic demand as the top economic priority for next year. For more, let's bring in our chief North Asia correspondent, Stephen Engel, in Hong Kong. So, Steve, what is the Politburo saying, and how should we be reading the policy adjustments that might come?
Right. So the Politburo meets every December essentially to set the tone for policy and priorities going for the next year. Then subsequently, and likely at the end of this week or possibly into next week, we're going to get the Central Economic Work Conference, where they will take those directives from the all-powerful Politburo and put it into policy formation, which will then again be discussed and ratified essentially at the National People's Congress, the annual session of Parliament in March. So this is a step-by-step process. And again, given the slowing momentum in the Chinese economy, given the uncertainties of the external situation with the trade war with the United States, albeit it is in a truce right now that should last a year, there was some expectations that there would be more forceful tone set by the Politburo as far as stimulus, as far as stimulating domestic demand / consumption, and maybe something as well on the property market. The readout, though, was fairly muted on those fronts, and that's why there was a little bit of disappointment in the markets. Essentially, you're seeing the Politburo with the face of Xi Jinping at the top of that pyramid, essentially saying we must adhere to domestic demand as the main driver and build a strong domestic market. But again, the details are not there yet. That has to be fleshed out by the Central Economic Work Conference and then again voted on by the National People's Congress in March. But again, it's likely a continuation from the current policy stance because essentially proactive fiscal policy will not change. Moderately loose monetary policy will not change. New productive forces, new technologies, emphasis in AI and all that will be boosted. So that kind of takes not a step back, but it does not necessarily address the overcapacity in industrial manufacturing as vigorously as some had hoped. So again, similar policy from this current year.
Yeah, given the challenges that you're mentioning, I guess not surprising that Goldman Sachs is calling this disappointing.
Yes, somewhat disappointing. Again, I think they were likely, a lot of people wanted to see a little clearer picture on what kind of stimulus, fiscal or monetarily, would be in the cards for 2026. But again, there were also, according to the analysts in this report from Li Shangwang, there was no specifics about consumption side of domestic demand. Domestic demand is fine with more roads, railways, and bridges being built and all that, fiscal outlays. But what about the household consumption as part of GDP contribution? Right now, it's about 40% of GDP. Some say there needs to be a specific target set of around 50%. So, when China sets a target, they usually go all out to meet that target. But there was no target set essentially from the tone of the Politburo. Maybe the Central Economic Work Conference will flesh that out a little bit. There was also no specifics coming from about policy, putting a floor on the property market. So again, it's a step-by-step process, but Goldman, according to the analysts there, saying although policymakers maintained their easing bias, they appeared less inclined towards broad-based stimulus measures at this point.
Steve, thanks so much. Stephen Engel, our chief North Asia correspondent, with the latest on the Politburo readout. On to some other top global headlines we're following. President Trump has signaled he could impose fresh tariffs on agricultural products, including Canadian fertilizer and Indian rice. It's the latest sign that protracted negotiations with two U.S. trading partners could drag on even longer. Two separate U.S. delegations are in New Delhi this week for talks, but officials say they don't expect any immediate announcement of a trade deal. The U.S. Congress is poised to enact bipartisan legislation targeting Chinese biotech and investments. The Biosecure Act and the Fight China Act would block certain Chinese biotech firms from government-funded contracts. It also authorizes the Trump administration to bar U.S. investment in Chinese AI and advanced computing. Ukraine and its European allies say they're increasingly confident of reaching a deal to use frozen Russian assets. Following talks in London, the UK Prime Minister's office says the discussions made positive progress on funding as the US winds back aid to Ukraine. But Ukrainian President Volodymyr Zelensky told Bloomberg before the London meeting that territorial and security issues require further discussion. Shery?
Take a look at how European futures are setting up. We saw some downside pressure in the previous session, especially given that we're ahead of that Fed rate decision. Not to mention that we got the first senior official of the ECB suggesting that potentially the move next year could be higher. In fact, traders now pricing in a 30% chance of a 2026 ECB rate hike. We have more ahead on the Asia trade. This is Bloomberg.
Paramount has launched a hostile cash takeover bid for Warner Brothers Discovery just days after the Hollywood studio agreed to a deal with Netflix. Following his warning that the Netflix deal may pose an antitrust problem, President Trump says he'll also be looking at the Paramount bid.
I have to see what percentage of market they have. We have to see the Netflix percentage of market, Paramount. the percentage of market.
Let's bring in Chris Palmieri, who leads our media and entertainment coverage in Los Angeles. So, Chris, this hostile takeover raised some eyebrows, or the bid for one. Talk to us, though, about when it comes to the antitrust bar. Thus, Paramount faced a lower one compared to Netflix.
Well, Netflix is such a large player in streaming, the largest globally, over 300 million subscribers, and Paramount Plus and Warner's HBO Max are both smaller. So even putting them together, they wouldn't be Netflix's size. So that's something regulators, I think, around the world are going to take a look at. It's still not clear, though, which way things will go. Netflix executives spoke at a conference today and said that they were still very confident that their deal is going to get approved.
What makes sense for Warner Brothers? Because we know Paramount's offer is for all of the company, Netflix only for the Hollywood studios, HBO, and their streaming business.
Well, part of this comes down to how you value the cable channels that Warner Brothers wants to spin off. That's CNN, TNT, Discovery, Home and Garden. Those are big names, but it's a declining business. And so Comcast and Warner Brothers both announced plans to spin off those channels to shareholders. Netflix doesn't want to buy them, and Paramount's offer includes all of the companies. So depending on how you value that spinoff, that's the difference between the Netflix and the Paramount bids.
Bloomberg's Chris Palmieri, who leads our media and entertainment coverage, is in Los Angeles following that very big potential deal when it comes to Warner Brothers Discovery. And in related news, Bloomberg has learned that Walt Disney is bringing Jimmy Kimmel back for at least one more year under a new deal with ABC. Sources tell us Jimmy Kimmel Live will continue until at least May 2027. We're told the host and Disney agreed on the extension months ago, but delayed announcing their plans out of respect for axed fellow late-night host Stephen Colbert.
Shery, in the meantime, let's take a look at how U.S. assets are faring across the board. We are seeing that bit of anxiety ahead of the FOMC decision, and what we get from the dots could inform 2026. Traders seem to be pulling back some of those expectations for cuts next year. We are seeing S&P futures bouncing back a little from the Monday selling, and the dollar still looking soft as yields continue pushing higher on treasuries. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at how we're setting up for the market opens across China. We have seen, of course, that Politburo readout making it a priority to boost domestic demand for next year. We also had export numbers out of China rebounding in November after an unexpected drop the previous month. We'll be digesting all of these numbers as we head towards the market open. The yuan has been relatively strong against the greenback. Not a lot happened in the futures session, but let's bring in our Asia equities reporter, Sang-Mi Cha. Sang-Mi, Goldman Sachs called the Politburo results somewhat disappointing. Is that why we're not necessarily seeing that big reaction in the pre-market session?
That's correct. And it seems like immediately after the readout yesterday, we have seen the moves actually pair some of those gains, and actually it closed down a bit lower. And we're seeing those moves earlier before the market opened as well. And just like Goldman Sachs said, the results were a little bit disappointing because they did not mention about the consumption drive that they want, or they didn't mention about boosting the property sector. So these were some of the main roadblocks that everybody wants to get rid of, and this is something that investors were hoping to hear more. But of course, stimulus is not something that is mainly discussed at the Politburo meeting, and of course, all eyes are going to be on the CWS the Central Economic Work Conference, where they're going to lay out all the policies, especially the economic policies for the next 5 years.
Sang-mi, even as the Politburo readout for the moment might have been somewhat disappointing to some, we are watching out for perhaps some easing when it comes to regulation surrounding the brokerage industry. What are you seeing there?
That's correct. We've seen the brokerage gauge onshore that already rallied 3% this month, and it's snapping that 3 months of losing streak. And we see that the CSRC's chairman, Wu Qing, actually came up with very strong comment where he said that China wants to create large and powerful investment banks by the likes of, JP Morgan and Goldman Sachs that can really compete globally through an M&A process. So that means consolidation in this market is unavoidable. And so smaller firms are going to be absorbed. So what happens here is exactly to actually tap those untapped household wealth. We're talking about some of 15% of securities and funds in Chinese residents' household asset. But to put that into a little bit of context, that's about just 30 years ago for U.S. level. So that means that there's a lot of wealth that could be tapped, and the CSRC and just regulators in general are thinking that through these M&A processes, they would be able to have those inflows of capital.
Sang-mi, thank you so much. Our Asia equities reporter, Sang-mi Cha, and as she was just outlining there, really about the stimulus signals or lack thereof coming from these Chinese policy makers. So we are seeing that domestic demand priorities for the economy, somehow pushing copper prices, nudging higher, following on already from them reaching their record highs. We are also seeing how U.S. imports are helping to spur on this rally. Of course, it's also the sense you get that when it comes to supply, the commodities market, copper specifically, is dealing with these shortages. When it comes to gold and silver, we are seeing prices steadying as bond yields climb ahead of the Fed meeting. So really watching central bank action as well, Shery.
Yeah, the RBA, especially today, expected to hold. Take a look at how Australian assets are setting up because the 10-year bond yield continues to climb, and this already at the highest level since November 2023. We just got the latest survey from NAB. Australia's business confidence falling to 1 in November, which is the lowest level since April of this year. Still, in the other parts of the economy, we have continued to see some strength. Home prices extending gains in November. Business investment also stronger than expected, at least for the last few months. So today's rate decision will be key. Will we see a hawkish turn? Let's cross to Sydney and Bloomberg economist James McIntyre. James, could this be one of the shortest and shallowest easing cycles in the developed world when it comes to the RBA?
Well, if this is what it is for the RBA, if that's it, and there's no more hikes, no more cuts from here, there we go, hinting at that move that markets are making, thinking that there could be a hike, then yeah, it would be one of the shortest. We've done a bit of work looking at all of the rate cut cycles that the RBA's been through over the last 30 years or so since they adopted inflation targeting, and right about the average has them cutting by 150 or 160 basis points. So they're halfway through. We think this is going to be a mid-cycle pause, but today it's likely that they're going to sound a little more hawkish given some of the data that's come through since that November meeting.
What are some of the other more high-frequency economic indicators telling us about the inflationary pulse in the country?
Yeah. So what we've seen come through, we've started to see Australia increasingly moving towards a monthly inflation measure. So we were one of the advanced economies that didn't have a monthly inflation measure. A lot of work's gone into it, and we've got the first set of proper monthly inflation data out, and it was much hotter than expected, coming in at 3.8% year on year. And that's really been the catalyst for this big reassessment that's happened over the last couple of weeks. It's really given fuel to this view that the RBA might be done inflation. And what that inflation was showing was that there was perhaps a bit more upside or persistent inflation pressure there in the economy. When we look at things like the NAB survey, some of the purchase costs, that was a little bit higher. The price of final products, though, that wasn't coming there. So that NAB survey is showing that there's a few signs of maybe margins copying a little bit of any lingering product or wholesale price pressure coming through the economy. But nonetheless, it's something that with the headline inflation in that new monthly being a little bit high, we think that the RBA is going to do what any central bank that's inflation targeting does, and jawbone against that, sound quite hawkish today, and no moves coming from them on the policy front anytime soon is going to be the signal we think the statement will deliver.
James, are we seeing the same level of strength both on the business side as households? Because, of course, we know that, for example, home prices have a deeper impact when it comes to people's consumption trends as well.
Yeah, so the home price side of the economy is actually really bubbling away quite strongly. We saw that move last week from the prudential regulator to try and rein in or get ahead of any potential build-up from investors piling into the property market as those price gains continue. We have the consumer spending looking okay, pretty strong coming through there. Business investment was fairly good as well. We got some very strong capex data coming in over the last week, and the GDP data reinforced that. It does, though, look like we are having one of the same features of the Australian business investment or business demand story that we're seeing globally, which is data centres coming through and being a big support, a big tailwind for that business investment growth. Whether the AI boom continues on or whether it has a stumble could be one of the factors about how durable that business investment pickup might be, and whether that business investment, those data centres deliver much jobs growth going ahead. So that's going to be one of the issues we think the RBA will be contending about when they think about where's demand now, but where's demand heading, and is it going to be strong enough next year? And so taking some time to assess that and extend this pause that they've been on since August is what we think they're likely to do over the coming months, and also in the first to start off the first couple of months of next year. So nothing really, we think, from the RBA on the policy front until the middle of 2026.
All right, James, let's regroup at that stage then. James, thank you so much for getting us set up for the RBA decision later today. Bloomberg economist James McIntyre. Now, coming up, the University of Sydney weighs in on Australia's ban on children having social media accounts. More details ahead. This is Bloomberg. Australia is set to enact policy that requires social media companies, including TikTok and Instagram, to block under 16s from holding accounts or face fines of up to $33 million. Joining us now is Terry Flew, Professor of Digital Communication and Culture at the University of Sydney. Professor, good to see you. So we are going to unpack, I guess, the for and against arguments for such a social media ban. But talk to us first how we got here after, 3 decades of mostly an unregulated internet.
I think that the pressure for policies along these lines has been building for about a decade. There's a lot of dissatisfaction with industry self-regulation and also a growing sense that a lot of the promises of social media have had significant downsides. So in Australia, the conversation essentially begins about 18 months ago, and there were various proposals around how to address issues around young people and adverse mental health consequences, and a social media ban was agreed upon by government, opposition and the state premiers as the best way in which to proceed along these lines, and legislation was passed 12 months ago. So we've now had quite a long lead time to put in place the implementation of the ban, which will be commencing tomorrow.
what about the potential, I guess, initial challenges for social media companies and enforcement? Because that seems to be something like a lingering concern for them.
Most, but not all, social media companies named in the ban have chosen to cooperate, most notably Meta, Snapchat, TikTok, YouTube reluctantly. There's an argument there about whether YouTube actually is social media, but they have chosen to comply with the legislation. It's important to note that the legislation gives the Office of the E-Safety Commissioner the capacity to designate platforms as coming under the legislation. It's also important to note that the onus is not on parents to implement this ban, but upon platforms to make the best measures to ensure that those who hold accounts on their platforms are aged 16 or older.
Terry, we know that kids, especially teenagers, really get around rules, right? They always find a way. What are the risks that we're pushing under 16 users to potentially more harmful parts in the online space?
That's a possibility, although I would note that the E-Safety Commissioner has the capacity to designate new platforms to come under the legislation. So there's been quite a debate about gaming platforms, for instance, and perhaps a odd arrangement where some platforms are subject to the ban, such as Twitch and Kick, but not Roblox, perhaps because Roblox have themselves implemented an age verification scheme. I think over time, the principal question about whether the legislation works will be seen around the rate of growth in the number of young people using social media platforms. If that begins to decline, and it could, because while there are a lot of online options, network effects mean that people tend to go onto the platforms that they know other people are on. If there's a decline in the number of young people's peers who are on particular platforms, then they may be moving off those platforms as well. And I think that would be taken to be a measure of success for the legislation.
And when it comes to legislation, has the potential positive impact perhaps on marginalized youth and how social media can play into that been taken into account?
There are certainly debates about that, just as there are debates about whether a ban is too blunt an instrument through which to address some of these issues. I think there is a strong case for saying that if there's a reduction in online social resources, then there should be a commitment to other resources for young people. I should say it's not actually a ban on using the internet. That would be ridiculous. But it is a ban on accounts on particular platforms, because the view has been taken that holders of accounts can be subject to algorithmic manipulation.
And also, what made 16 the right age for these restrictions?
Well, I think that's a debate. I mean, one challenge is that, of course, in the US, the threshold age tends to be 13. And I would say that given that many of these platforms have had a rule for a long time that only those aged 13 or older can hold accounts on them, had those laws actually been implemented at the time they were created, or had those rules been implemented by the platforms, we may not be having this conversation. But the fact is, for 20 years or more, they for the most part haven't. So we do find ourselves with an arrangement around under 16. But there is certainly a debate around developmental stages of childhood in that regard, about whether those aged 14, 15 have a greater degree of maturity than those aged 12 or 13. But I would say, at least in Australia, there's been less conversation about the age at which it's been set, but around the principle itself.
As you alluded to earlier, there's a debate still about the extent in which this maybe constitutes a bit of overreach on the part of authorities. And there are other countries, developed economies included, that are looking at Australia as a sort of example of what they can bring on to their regulatory environment. How do you think they will be watching all this as it unfolds?
Well, I think that the principal question will be, in the first instance, will we see mass civil disobedience against the legislation? I don't think that will happen, but there's certainly a lot of talk around young people using various measures to circumvent the rules, such as VPNs, such as fake IDs, and so on. Actually, the laws themselves are very difficult to implement without some level of parental support. So I think the measures are in part about empowering parents who've felt very disempowered in their dealings with young people's use of social media, and I think that has attracted attention internationally. Whether the age is going to be the age at which other countries land on will remain to be seen. In some countries, such as Malaysia and New Zealand, that is the talk. In others, such as Denmark and France, they're perhaps looking at a lower age, such as 14. But the general principle that a largely unregulated internet where children basically have access to the same content as adults, a sort of 30-year experiment that we've had in this, has been deemed to have a significant number of downsides, and the number of people making the case that nothing should be done in this area, I think, has been diminishing over time.
Terry Flew, Professor of Digital Communication and Culture at the University of Sydney, with this fascinating development in Australia, the first of its kind ban on social media accounts for children in the democratic world. We have more on Australia Ahead every Tuesday, 11:40 a.m. if you're watching in Sydney, 8:40 a.m. in Hong Kong. Also, you can tune into the Bloomberg Australia podcast. It delves into the biggest stories shaping the country's role in global business. Find it on Apple, Spotify, or Bloomberg.com. More ahead on the Asia Trade. The top corporate stories that we're tracking: PepsiCo has announced a series of operational changes backed by activist investor Elliott Management. The moves include cutting nearly 20% of its U.S. product lineup, investing in more affordable products, and planning layoffs in North America. Elliott says the plan will drive greater revenue and profit growth. Morgan Stanley has lowered its rating on Tesla to the equivalent of a hold. Analysts say the company's full valuation, driven by its stock price, already reflects its robotics and AI businesses. The firm says Tesla is positioned to be a leader in humanoid robots, but EV sales volume in North America may fall 12% next year.
Shery, staying with autos, a new Bloomberg Intelligence survey says almost half of Chinese first-time car buyers want a battery-powered electric vehicle. That's up from 25% from a previous poll in February. Let's bring in China auto analyst Joanna Chen. Joanna, where is this momentum coming from despite the global slowdown?
Yes, hi. So according to our latest BI survey, we're definitely seeing that Chinese consumers are increasingly favoring battery electric cars. I mean, like over half of them said that prospective car buyers said that they're tending to go fully electric in their next purchase. And I mean, if we break down the numbers, like look at the demographics, basically consumer interests are higher across the board, but specifically this time around for first-time car buyers, they are really saying that they want to, over half of them want to go fully electric because first you have this massive model supplies where BEVs are really affordable and there is no budget issues, and second, all those buyers, I mean especially first-time car buyers, they are younger, they are really attracted to all those cool smart tech features where you have autonomous driving, you have connectivity, you do a lot of like karaoke and all those fun stuff in the cars. So that's where really the momentum is coming from, even though we're seeing some slowdown in other regions like Europe and the US.
Will there be implications, though, given that the government is phasing out subsidies now?
Yes, indeed. So we are seeing like 2026 sector growth is going to be slower, and mostly two reasons. First is subsidy cuts. The second is that the higher base effects. I mean, you cannot always grow at 50 40 or like really high double digits rate forever, right? So, but in terms of like adoption rates, we can see that the electric vehicles are still eating the market share of traditional gasoline cars. And if we look at how China plays it, it's really smart actually. The government are pulling back on subsidies on EV purchases so that those underperforming brands, those are less competitive and overly reliant on government grants, those kind of brands, they are going to gradually exit from the market. And then all those resources that used to be in those purchase subsidies, they can flow to charging infrastructure to further support the long-term and sustainable growth of the overall EV sector. So that's where we think the sector is still healthy and the adoption rates are still going to rise over the longer term.
Bloomberg Intelligence China auto analyst Joanna Chen there. Great to have you with us. Of course, those are some of the stocks that we'll be watching at the market opens in mainland China and Hong Kong. But these are some of the other stocks, especially chip-related stocks, after President Trump granted Nvidia permission to ship its H200 AI chip to China in exchange for a 25% cut of the sales. Trump saying that the U.S. will apply the same approach to other chip makers, including AMD and Intel. Avril.
Let's take a look at some of the benchmarks across the region as well, as Japanese equities are facing slight pressure. And this is, of course, ahead of the Fed. We have some BOJ caution in the mix as well. It's worth noting that among stocks, chips, as you alluded to a short while ago, looking pretty solid. But there is that bit of risk off in the region, tracking those declines on Wall Street. That's it from our Asia trade coverage on the markets. We look ahead to the markets open on the China show next. This is Bloomberg.